In the world of commercial real estate, one number stands out above the rest for investors: the cap rate. But what exactly does it tell you? Cap rate, or capitalization rate, is the ratio of net operating income to the property asset value. It's the primary way to compare investments. The math is simple. Take the net operating income and divide it by the property's purchase price or current market value. Remember, net operating income is your gross income minus all operating expenses, but before you account for debt service or taxes. Think of the cap rate as a measure of risk. It represents the natural rate of return for a property for a single year, assuming it's bought with cash. A low cap rate, like 4 or 5%, usually indicates a safer investment in a prime location with high demand. Conversely, a high cap rate, say 8 or 10%, often suggests higher risk, perhaps in a secondary market or an older building. Investors use cap rates to compare apples to apples across different properties in the same market. Different asset classes, like multifamily, industrial, or retail, all have different benchmark cap rates depending on market conditions. Location is everything. A downtown office building will almost always trade at a lower cap rate than a similar building in the suburbs. Cap rates are also influenced by external factors like interest rates. When rates rise, cap rates typically follow to maintain an attractive spread. It's an inverse relationship. As property values increase, the cap rate decreases, assuming the income stays the same. This is why value-add investors focus on increasing NOI. By raising rents or cutting costs, you can increase value without the cap rate changing. Let's look at an example. A building generating $1 million in NOI sold for $15 million has a cap rate of 6.6%. Investors also consider the exit cap rate, what they expect the cap rate to be when they eventually sell the property years later. Cap rates provide a snapshot of market sentiment. Compressed cap rates indicate a seller's market with high demand. For buyers, a higher cap rate means they are paying less for every dollar of income the property produces. For sellers, a lower cap rate is ideal, as it means their property is valued more highly relative to its income. Tenant credit quality also plays a role. A building leased to a government agency will trade at a lower cap rate than one with local startups. Long-term leases with built-in rent escalations are highly prized and lead to lower, more stable cap rates. In times of economic uncertainty, cap rates often expand as investors demand higher returns for taking on more risk. Understanding cap rates is essential for navigating the complexities of commercial real estate valuation and investment strategy. I'm here to help you make sense of the Memphis market. For more insights, visit memphisglen.com or give me a call today.